Now we start about deferred tax, which we talked before. So deferred tax, actually, they are temporary differences. So deferred tax, what happened? Let me explain that. Deferred tax, it arises due to difference in tax base. Now, what is tax base? I'm going to explain you in some time. So deferred tax, these are called temporary differences. And you have two types of them. You call it deductible temporary difference. Deductible temporary difference. And you have, chargeable temporary difference. So let me go back and create some example. Usually deferred tax, it's a tax which you have to pay now, but in future you can recover. Or maybe you pay more now and in future you pay less. What usually it comes from, deferred tax, it happens from different sources. And two very common sources are, one is revaluation. So one is when you do revaluation of your non-current assets, or maybe due to depreciation methods. And we call them that they arise due to timing differences, okay? Timing differences. Timing differences means that you pay now less and in future you will pay more. So timing differences happen. Let me explain you. Let's suppose that you purchased a car. So there is a cost of, so let's suppose that you have an asset and the asset has, $20,000 its cost, and the life of the asset is 5 years, and you use straight line method. And in 5 years, you make it zero. So what you are doing, you are actually charging a depreciation of $4,000 in your income statement, okay? A $4,000 depreciation you will charge, so your depreciation expense. And you know that your depreciation expense, it will bring some tax benefits because that's an expense, and it will bring 30% of the tax benefit. Now, listen. When I told you that if you spend $100 on electricity bill, you immediately claim the tax benefit. So on $100, your benefit was $30, like 30%. If you pay $200 rent, you immediately claim a 30% tax benefit, which means a 30% tax reduction, which is $60. Now, this is $20,000. This is also going to be spent out. This is also going to be an expense, but this is an expense over a period of 5 years. So logically, when you spend $20,000 on a car, this $20,000 should also give you 30%, which means, 20,000 into 0.3, it should be giving you $6,000 of tax benefit. But the issue is that this 6,000 benefit you will not get in 1 year, because this 20,000 is not an expense for 1 year. This is an expense for 5 years, because this car will become from 20,000 to zero in a period of 5 years. You are losing $4,000 per year. So what will happen that you have here in year 1, in year 2, in year 3, and in year 4. And in year 5, there are 5 years. There's a 5-year life of this car, okay? And what you are doing, you are showing 4,000 expense in every year. And here is your 30% tax benefit. So you say like 4,000 into 0.3, okay? So you are collecting your benefit, 4,000, 4,000, 4,000 in next 5 years, which is 30%. I'm sorry, I took 40%. 30% is like this. So I am claiming my tax benefits like 1,200, 1,200, 1,200 every year, because I am charging a depreciation of 4,000. If you pay attention, the total of this benefit is the same, 6,000. Just like we make 6,000 here, the 6,000 here. But what is happening that I am collecting this benefit over a period of 5 years, because the car has a life of 5 years. And my accounting policy, according to IFRS, we decided, it is our internal decision, that we will do straight line depreciation. So this is one situation. But then what happens? That when you go to the tax department, the tax department will say that you have to charge, 20,000. This is vehicle. You cannot charge straight line. You must be showing the reducing balance method. You have to use the reducing balance method depreciation on this vehicle. So if you have to charge the reducing balance, what you would do, you would say, and they say reducing balance 25%, let's suppose. They say reducing balance 25%. So you would say, 20,000 into 0.25. So you come here, $5,000 your expense, and I put here 30%. And then in next year, what will happen? That reducing balance means that the next year you will have 20 minus this 5 into 0.25. So I'm putting it 25% reducing balance method. This is what you can calculate here. And then in next year, you will have again 20,000, this much, minus 5,000, minus this one, multiplied by 0.25. So that's how you are calculating your reducing balance method. And then you would again say 20,000 minus this one, this one, this one, into 0.25. And whatever is remaining, that you put in the last year. Let's suppose I'm just creating a scenario that whatever is remaining, you put it in the last year. So how much is remaining? This is like 13,761. So I would put 20,000 minus 13,761 into 0.25. So when I make a total of these numbers, this will also give me into 0.25. Where did we charge it is? How much? 20,000. Okay. Okay, I have to charge the depreciation here. So it is almost like 20,000. There is some difference. We can adjust it. Let me write down here. 20,000 minus this depreciation, minus this, minus this, minus this. Whatever is remaining, I'm putting there. And then you start charging your, actually, I did something, 20,000. And now you get your tax benefit. Your tax benefit will be, so this is the way you calculated your depreciation, like 25% on reducing balance. And now you have to calculate your tax benefit because you are showing expense 5,000 here. So now you have to charge this expense into 0.3. So these are going to be your tax benefits. And when you make a total of that, it is also 6,000. So I get 6,000. I should be getting a 6,000 benefit. My total benefit should be 6,000. I am getting a 6,000 benefit in case of straight line, and I am getting a 6,000 benefit in case of reducing balance method. But there is a difference. If you see here, your tax benefit is different. So now what is happening? According to IFRS, you would say that, this is my tax benefit of 1,200. But according to the tax department, your tax benefit will be different. It is like 1,500. So let's suppose, now I'm just creating some scenario here. So let's suppose that you have your profit before depreciation. So I'm creating a scenario now. I will say that I have my profits before depreciation. Your net profit before depreciation was $10,000. And then you say depreciation expense, which is like 10,000 minus this much. So you calculate your depreciation expense as this much. And here you say that profit, taxable profit. Your taxable profit becomes, your taxable profit will become 8,800, okay? 8,800. And here you should pay your corporate tax. How much corporate tax you should pay? Tax rate is, let's suppose 30%. So I should be paying a tax on 8,800 times 0.3. So according to IFRS, my tax amount will become 2,640. Now, if I follow the same thing here, I say that my profit before tax and my profit before tax is the same numbers I'm taking here, like this. So my profit before tax, let's suppose, is 10,000. And I'm saying my depreciation expense is 1,500, is like 5,000. Actually, I have to write down this tax benefit. I think, so we've got here profit before, so we just assume a number, profit before depreciation 10,000. This is your depreciation expense, okay? So we show it as an expense. So your taxable profit is 6,000. And on this taxable profit, you pay 30% tax, which is 1,800. And what you can do that, you can just copy paste it for the next periods, let's suppose like this. So this is almost the same. We assume that my profit before tax is same, my depreciation, of course, it is same. And this is what you have to pay the taxes, okay? Now, when you come back and see your tax department say you that you have to charge depreciation like this. So you would be saying 5,000 depreciation here, okay? And your taxable profit will become $5,000. And then on this taxable profit, you have to pay 30% of tax, and 30% of tax will become 5,000 into 0.3. It is just 1,500. Now, what is happening here? According to IFRS, I believe that I should be paying 1,800 tax in year one, but the tax department comes and says that no, you just pay 1,500. We are fine with that. I know that tax department is asking me less. Okay, according to my accounting calculation, I should be paying 1,800, but the tax department is happy with just 1,500. They are taking less. But what will happen that in next year, they will start asking more. If I pay less here, I will have to pay more in the next period. Now, if you pay attention to these numbers, we'll take it here. And when we see this one, it goes like this. Now, let me just organize these numbers a little bit. And I'll organize these ones as well. Just do some formatting. So how much tax you paid? Actually, if you make a total, you paid $9,000 tax. And if you make a total here, you again made a $9,000 tax. Your total tax paid is same. But what is happening? In different periods, there is a difference in number. According to IFRS, in year one, I should be paying 1,800, but I paid only 1,500. Next year, again, I thought I should be paying 1800, but the tax department, they came in and they took a little bit more. Then I paid this much. I thought that I should pay 1800 according to IFRS. Tax department came in and they asked me more. And here they also asked me more, but in next period they asked less. So the total tax paid is same, but in individual years there is a difference. So there are differences, okay? There are differences. And how much are those differences? Let's calculate them. So this is this much and this much. I call it minus 300 and I put it here. So in some periods, if you see that it is minus, in some periods it is positive, and when you make a total, it becomes 0. And that is like the difference. There is no difference remaining, and that's why I call it temporary differences. Now, this one, in this period, I have a liability. In this period, I call it a liability, okay? Because why do I call it liability? Because you always have to see from IFRS to the tax department perspective. According to IFRS, I should be paying 1800. I mean, according to my own calculation, I should be paying 1800, but I paid little less. So I know that I will have to pay next year this 300. So it's my liability. When it becomes positive, it is called asset. And then this is also, you have asset. Asset means that according to my own calculation, I should be paying only 1800, but the tax department came in and they took 1875. So it looks like that I'm paying 75 more. I will pay 75, no worries, because I know that in next period, somehow I will take it back. I will recover it here. And this liability is called temporary. So these are called deductible differences, okay? These are called deductible differences. Deductible means that you have to deduct in the next period. You have to pay. It's a liability. And these are chargeable. I'm sorry, liability is chargeable. I just wrote it opposite. These are your chargeable and these are your deductible. So this is a scenario, what you call a deferred tax. A deferred tax could arise due to the reason of, you call it timing differences. Timing differences means that, I show expense this year, 4,000. According to IFRS, I'm showing 4,000. And tax department says that you can show 5,000. So I'm showing expense less. Tax department is showing in the textbooks, we will show it more. But ultimately the total expense, if you pay attention, the total expense, we will write down 20,000 here. And this is the same 20,000, which you will put here. If you pay attention, these one, this is also 20,000. So the total expense written in 5 years time is 20,000, but the timing of expense is different. And that's why I call it timing differences. So this is a tax, deferred tax asset or a deferred tax liability has arisen due to the timing differences of expenses. Like there's a difference in timing. I write it this year, tax will write it next year, or I write next year, tax writes this year, and they will keep on moving. And that's why you call them non-current liabilities. You don't have to pay it immediately because you know that they will be settled out in future. Similarly, deferred tax may come up with the base of, due to your revaluation of non-current asset. Let's suppose that you made a revaluation of non-current asset by $100,000. So that's a gain. That's an income. And any income, any gain, it immediately creates a tax liability. Okay. So there is a tax liability, but it is deferred tax liability. You will create a $30,000 tax liability. You will create a $30,000 tax liability, but you will call it a non-current deferred tax liability. Why? Because in next year, it is possible that asset may go down to 90,000. Now, you have not realized this gain. You should remember that you pay taxes on realized things. It's an unrealized transaction. It is just on the books. In my books, according to me, my asset has gone up. If my asset goes up, I made a gain, I should be paying a tax. But the thing is, I have not sold the asset. I'm still using the asset. Why should I pay this tax? I have not realized this gain. If I sell the asset and I made $100,000 more, then I should be paying the tax. I'm not selling the asset, I'm still using. And it is possible that next year, it may go down by 90,000, okay? If it goes up, revaluation can happen, impairment can also happen, IS 36. So if it goes down, will I go back and take money from the tax department? You see, I gave you tax last year, now you give me back? It will not happen. So what happens that on revaluation, you also create a deferred tax and you keep it in your books as a liability that when this asset will be sold, at that time, this liability will be settled. And these deferred tax balances, they keep on moving up and down because as your assets, they move up, you create a deferred tax liability. And when maybe there is an impairment is happening, your deferred tax liability goes down. Again, it goes up, again, it goes down, and it keeps on moving. You only pay the differences, whatever is the difference that you take into your tax expense. Now, we said that during the year, you have current tax and you have deferred tax. You have two types of taxes during a year, current tax and deferred tax. And your total tax expense, it consists of both. When you calculate your total, I'm putting it in bold, your total tax expense, it consists of both the current tax and deferred tax. But what you pay is only the current tax, okay? You do not pay the deferred tax. Deferred tax is not something which is your current liability. It goes into the balance sheet under non-current liability section. And you should remember that sometimes you may have deferred tax assets. Like in certain periods, if you have paid more, so you always start from, start with IFRS tax and compare with taxable profit with the tax rules. Compare with the tax rules. So if according to IFRS, let's suppose that my IFRS says that your tax expense should be 2,000, and my tax rule, my tax code says that you have to pay 1,700. So it means that here you are creating a tax liability, okay? A tax liability, because in your books it was 2,000, but you paid only 1,700. So you have a $300 tax liability, and it could be vice versa. If the IFRS tax is less and tax is your taxable, your profit is more, in that case, you will create a deferred tax asset. Here it is a deferred tax liability. So deferred taxes, they arise because of the revaluation thing. They happen because of the timing differences. They are adjusted in the future period. They are non-current assets, non-current liabilities. We do not pay them in the current period, and their values may change on the balance sheet. Their value may change on the balance sheet. There is a word which I said it in the very beginning when I started. I said that word that is called tax base. Where is that? I wrote down the word tax base. Tax base. This is one last word I have to speak, and then I want to finish this lesson for today. Tax base is the amount of an asset or liability for the tax purposes, for the tax calculation purposes. I give you an example. Let's suppose that you have an asset which has $20,000 cost, and it has a residual value of 0. So the tax base is 20,000, which means that for the tax purposes, you will write down all 20,000 in expense, just like we wrote here. How much expense did we charge in the books? 20,000. How much expense we charge in the book? 20,000. So the tax base is equal for both of them, because according to the tax rules, you are going to show a total expense of 20,000, and here you also showed a total expense of 20,000. 20,000 is the amount for which you include into your tax books, okay? For the tax purposes. So you say my $20,000 asset becomes 0, my total expense is 20,000. I am going to claim the tax benefit on 20,000, which is 30% of 20,000. So I am going to claim a net benefit of $6,000. Okay, just like here you did $6,000. This is the benefit you just claimed. This is the benefit you claimed. If on the other hand, you have an asset for $20,000 and you believe that it has a residual value 5,000, which means end of the useful life, the asset will have some residual value of 5,000. So it means you will only depreciate 15,000. So in your textbooks, you are going to write down 15,000 expense. So now your tax base is 15,000. Tax base is that amount which you take into consideration for the calculation of tax purposes. Whether you are you are charging it in form of a depreciation, or you are calculating tax on that. So tax base would be that amount which will go into your financial statements for the tax purposes, for assets or liabilities. So you can now read this chapter from the book. We did it quickly. It was current tax and it was deferred tax. The most important calculation will be what you do in question. One is that they ask you how much is the total expense for the year. And for the total expense for the year, we need to make the deferred tax adjustments and the deferred tax balances. Hopefully, when we will do next question in class, we will understand it in more detail. But this is, this should be enough for reading the book. You start reading the book, your chapter, and next class when you come in, you should come in with after watching IFRS 9 videos and the tax thing. And next lesson is only for doing questions for tax and IFRS 9.